Hello, good afternoon and welcome to Mutual Fund Corner on CNBC-TV18. I'm Vinnii Motiwala. Today what we're going to be doing is we're going to be decoding the AMFI data, the mutual fund data that came in yesterday. What were we seeing there? Because mutual funds saw a strong inflow in the month of January. Equity segment saw an inflow of for the 47th straight month, and that is at around 39,688 crore rupees. Previously versus on a month-on-month basis, in the month of December, it was at 41,156 crore rupees. Mid and small cap schemes also saw strong flows for the sixth straight month. And we're going to be decoding all of this with Nasser Salim, Managing Director at Flexi Capital, to decode the AMFI data and what are the trends that we're expecting going forward. Just to take you all through some bit of a precursor also. Overall, the flows turned positive, and this was due to the inflows in liquid funds that we saw this time. AUM came in at around 25.9 lakh crore rupees. NFOs saw a bit of a weakness in terms of inflows. Keep an eye on that. Our total of just 12 schemes were launched in the month of January for the NFO side. All equity schemes were showing inflows for the fourth straight month. So we have a lot of interesting points to talk about, and that is what we'll talk about with Nasser as well. He's here with us on the show today. Nasser, good afternoon, and thank you so much for joining in with us. AMFI data looks very interesting this time, but firstly, I want to start with those equity-oriented schemes, right? And when you're looking at it in terms of the inflows, seems like a bit lower in terms of certain categories that we're seeing. Seems like some signs of a slowdown is coming in. Is that some concern that we're watching out for? Though the number seems very healthy from previous years or previous quarters, but still, that fear does come in, right? Because the volatility that we've seen in the market.
Good afternoon, Vinnii. Thank you very much. It's always a pleasure to be on CNBC. So to your point, I think clearly, if you look at, and I'm going to break this up in two parts. So one is a general view on, the equity allocations that have come in between December and Jan and the uptake in that. And the second is, the more interesting part is the difference between T30, which is top 30 cities, and T30, which is, beyond 30 cities. So to your first question, equity funds remain resilient, but showed signs of moderation, no doubt. And more importantly, what we've seen is small and mid-cap funds continue to attract strong investor interest, as we speak. However, sectoral and thematic funds, if I break within the equity funds, witnessed good amount of profit booking, and that's also available in the data, if you peel the onion there, suggesting a more cautious approach to those investments, Vinnii. So that is one point that clearly we've seen. The other quick one is that, in the equity category, if you look at hybrid, those have gained traction. Now, those predominantly have gained traction because, they're lower risk and they're far more tax efficient as compared to pure debt funds, reflecting a shift towards a balanced portfolio strategy also that is available. Meanwhile, passive investing remains steady as well. So that is broadly to tell you that there is a word of caution. The street view, of course, as we all know, is that the earnings have been a little mixed. And there is cautious, which is a word of caution that is coming in to ensure that you have a balanced approach, and which is evident in the data as well.
Okay, good roundup that's coming from you, Nasser. But, I have a lot of points coming out from what you've just spoken about. Because that mid and small cap, normally when you see that jitter coming in, why are we still seeing so much interest for mid and small cap, right? Isn't it a bit of a concern? And given the volatility, do you think this trend may not continue then going forward in the next few months?
Vinnii, clearly, if I look at price to earning bands today, and if I look at large cap, mid cap, and small cap, if you look at the 10-year historical averages in terms of price to earning bands, mid cap is trading at some 25, 27 times 10-year historical averages, which is also very high. Small cap, on the other hand, has been around 46 to 47 times 10-year historical average. Now, one of the view is that, and of course, this is something which, as distributors, as people engaged in the financial industry of distribution of services and investments, we feel that, there has to be more imparting of knowledge. Today, a lot of investors are going into mid and smaller caps because they've seen past performances doing really well. We saw this huge upsurge in returns on equity funds, predominantly from mid and small. And therefore, one of the factors is that, it's a fear of missing out. So a lot of new investments start chasing mid and small, while we feel that there is some amount of caution that should be, looked at a very, very clearly from a price to earning perspective. As I told you, it's expensive. And one is that. The second quick, of course, is past performances. But we keep talking about to all the investors saying that you just can't go on past performances. Today, the opportunity is in a different market cap, right? Which is purely large cap in our opinion. So I think that is one of the main reasons why we're continuing to see a lot of upsurge in those, but which will start to come down because in volatile times, the larger hits because of higher beta. Not getting into very specific ratios, but the more volatile in indexes, the harder is when small and mid caps take a drawdown on the portfolio.
Absolutely.
So that is something which will start to play out as well, and will slow down.
Okay.
In terms of allocation.
While obviously we spoke about mid and small cap, you did touch upon hybrids as well. Now that is gaining traction, is what you highlighted. While mid and small cap is also something that is seeing a growth, but that traction is also good, right? Because that seems like a bit more of a conservative approach that maybe an investor is looking at.
Vinnii, I would use the word moderate as far as moderate between moderate and aggressive, because you please do understand that there is almost 60-65% in equity-oriented schemes there as well. But there is some edge built in, right? When you look at a hybrid, kind of an equity hybrid fund, right? Yes, I think today the shortlisted options that are available to clients from a hybrid space are interesting. There is also an anticipated, which we saw also right now, the RBI coming in and pushing for rate cuts. They've done a 25 basis rate cut. Yields and debt funds, they have an inverse relationship between yields and interest rates. So that will also start to play out when interest rates come down, yields start to go up, come more attractive, prices goes up. So I think that is again something which will allude well to this entire hybrid category. Also, the fact that today everyone is talking about frothy valuations, right? Specifically in mid and small. So we feel that while large caps are a little better positioned, far better positioned as compared to small and mid caps, a recommendation or options within hybrid also bode very well, given that we will anticipate and see volatility over the next few quarters, which is not something that no one's saying. Everyone is saying that there will be volatility, and therefore to kind of protect any major downside to one's funds, a hybrid will start to play out, and will be a natural hedge.
Right. Okay, I think we did just lose the line with Nasser, but he was talking about how hybrid also is a scheme that has been gaining traction. Investors are becoming more conservative toward their approach, just taking out through the numbers also. So hybrid scheme, they saw a net inflow of around 8,767 crores in January, which was up from around 4,369 crores. We do have Nasser back with us as well. And Nasser, you were talking about hybrids right now in terms of a move that is coming in. My follow-up on this one is for hybrids and from hybrids also. We spoke about the interest rate cuts and everything that's going around. In hybrids, what is the best option that an investor can look at right now as well? Like I was mentioning those numbers, that hybrid overall as a scheme has seen an uptick. In that also, balanced hybrid, aggressive hybrid funds or arbitrage funds, what is looking the best option?
Very difficult to give you the best option available because it's subject to one's product suitability and risk profile. But broadly, if we look at hybrids, we look at a new category which is, which comes in the form of multi-assets. Now that has a mix of equity thrown in. It has a mix of commodities, like it has some gold in it. It also has debt. So it's a good combination. Today, we're also looking at some data to say that in any market scenario when it is marred with volatility and with some amount of price swings on the index, a multi-asset strategy works very favorably for investors in the portfolio. So, for example, something like a good multi-asset fund which has gold thrown in a bit, and we feel gold, for example, has seen again a huge significant surge in isolation, right? Pointing to increase in investor preference for safe haven assets. So that's again something which we feel multi-asset is a good category. The other one that we feel for conservative, since you use the word conservative, for moderate and aggressive will be multi-asset, kind of a hybrid strategy. For somebody who's conservative and conservative to moderate, you can look at something like an equity savings, which is also, it's bordering, it's an arbitrage with a mix of debt and equity, which gives you equity taxation as well. And those are again something which, come on erstwhile in the category of arbitrage plus. Now it's called equity savings. So that's again something which can be looked at. PAF, you said, which is balanced advantage funds are again very, interesting between for a moderate to a aggressive investor. So I think it's a good mixed bag between conservative, moderate, and aggressive product suitability. And that is something which clients and investors may consider.
Right. Nasser, let's talk about the hot topic that was last year in 2024 was NFOs. Now seems like, people are seeing that, they have to judge where they are investing in it because it's sector specific. And that is why it seems like a bit of a sluggishness that we're seeing this time in terms of the numbers that have come in terms of NFO trends. Do you think that's the trend that will continue 2025 as well? And, is there something specific that an investor should be doing while looking at these NFO funds?
Very, clearly, as far as NFOs are concerned, NFOs try to capture, and this is more AMC specific, right? So forget the investor right now. We're talking about more from an AMC perspective. I think their end objective is to make sure that every pie is available to their investors. So NFO as a strategy, by and large, is something which one should not be worried to say that, why are so many NFOs coming in? Yes, there is a trend that is coming in, emerging that, we saw only 12 new schemes in January, which was significantly lower than in December. In December, when we had 34, for example. In January, we have 12, right? But I think from an AMC perspective, when they're launching, they want to cover every aspect in the markets, and therefore they launch NFOs. One of the recent NFOs that, was trying to capture is rural economy and rural markets by a large asset management company. So that's a theme that they believe in. So it's not a bad idea. But from an investor perspective, when I come into as an investor or from an investor perspective, very clearly, from an NFO perspective, at best, if you have too many NFOs in your portfolio, all of a sudden you'll see there'll be one overlapping, so there'll be a lot of common holding individual sectors, scripts in them. Number two, I think the entire discussion between core and satellite will go for a toss, in my opinion, right? Because that is something which is more important to have engaged with your advisors, distributors, and understand, what is the kind of exposures you can take in NFOs. I think the broad figure that, back testing, if you look at data, suggests that, anything between a 10 to a 20%, depending on the size of the portfolio, a 10 to a 20% allocation in new fund offers from reputable AMCs is something which is good to go with. But again, it's a function of, investor appetite, risk product suitability, what is the kind of existing exposures they have, top holding sectors in your portfolios at a fund level. So I think, it involves a lot of broader discussions, but a broadly 10 to a 20% allocation in NFOs may not be a bad idea, subject to, as I said, the product suitability.
Okay, Nasser, thanks so much for that. We have had this discussion about equities, NFOs, as well as hybrid funds so far from the AMFI data point of view. We're going to take a short break, and after the break, we'll talk about debt schemes. What have they been doing? Overall, the outlook coming in from smaller cities and towns, so don't go anywhere. Welcome back, and thanks for staying tuned into CNBC TV18. You're watching Mutual Fund Corner. We still have with us Nasser Salim, Managing Director at Flexi Capital, to talk to us about the AMFI data and decoding more on that. Nasser, let's move on and talk about debt schemes. With those interest rate cuts, I was just talking and having a conversation in terms of debt mutual funds and how they start becoming attractive, right? And this month, in the month of January, we have seen a rebound versus December month. Could you explain us, how this actually moves forward? And do you think that what we're seeing in terms of a net inflow this time is something, a sort of a rebound that is possibly and could continue because it becomes more attractive given the rate cut cycle?
No, absolutely, Vinnii. Great, interesting point and question there. I think clearly, before we get into why debt funds, we'll just explain in a few seconds and why they actually make sense today and why we will see this trend in continuing to increase over the next few quarters and months. See, if you look at the broader perspective, India's consumer price index inflation, which came out, decreased to 4.3% in January, as against 5.22 in December. That's a 5-month low, by the way, and the reason was because of food inflation, which came down to 6.02 in January, as against 8.39 in December. Vegetable prices came down, core inflation's also come down, excluding food and energy. So this downward trend, Vinnii, broadly, in inflation enhances the likelihood of further monetary policy easing, as simple as that, by the Reserve Bank of India, which we also saw a few days back, to support economic growth, right? The Reserve Bank of India, to support economic growth, will look at easing of monetary policy. And when that happens, the policy easing will certainly get a lot of attraction in debt MFs as a category, which I told you in the beginning of the show as well, that they have inverse relationships, right? When rates come down, prices go up of bonds. So moreover, this as a category is something which will continue to attract now, because as I told you, interest rates come down, and therefore one is that. The second thing, of course, is that from an asset allocation perspective, today a lot of clients, investors also require that hedge in the portfolio, a natural hedge against any market corrections or drawdowns as far as equities are concerned. So I think that is again something which is now will play out really well over the next few months. And I think the category in which debt funds will be participating more will be where there are better taxation advantages. So for example, something like an equity savings, it has a debt component also in it, because today anything short term, is as per marginal taxation slab from a taxation perspective. There is necessarily for 2 years mandate you have to hold to get that 12.5% kind of a capital gain. So I think debt today, or in the category of debt, hybrid debts will also do well and will attract far more interest and appetite from investors' perspective today, as we see.
Right.
And the trend will continue, Vinnii.
Absolutely. So that's becoming very interesting as well. A lot of points that you highlighted also, why debt mutual funds maybe right now is the time that it looks more attractive to an investor. Nasser, what's also interesting that over the last few months and years, we've seen that significant increase that has come in from the B30 as well as T30, right? Now, 19% of the total mutual fund industry assets came from B30 locations, and this is the data that we are looking at is for December 2024. As a trend, what are you seeing? And, could you talk to us more in terms of, is there some specific contribution that comes in from different states? Any highlight on that front? And B30 and T30, how do you see that moving in terms of contribution going forward?
Right. So Vinnii, again, great point here. I think if you look at the trend line and if you put this on a month-on-month trajectory, what will emerge is that today the aspiration India, or rather the India that wishes to invest in Bharat or Hindustan, is waking up and saying that, listen, there is an opportunity here for regulated products, right? And I think I must, allude to all participants in that, whether it's mutual fund Sahiye campaign by AMFI, by SEBI's, clarification on mutual funds, people like you who talk about mutual funds. And I think that is evident now in this entire, this journey between T30, in this case is top 30 cities, as we all know, as against B30. So the asset mix is changing every month. And it is beautiful because it tells you that B30 assets have increased from a number of 12.44 lakh in November 2024 to almost 3% up to almost 12.85 lakh crores, right? So there is a massive increase in beyond 30. And if you compare this to December 2023, which is almost a year ago, B30 assets grew 9.08 lakh to 12.83. So there is a 41% increase from a 1 year perspective, point to point, December 23 to December 24. And every month there is a number of increase which is adding to that. Now, I think the other interesting piece on that is, Vinnii, is that if you look at the composition or the breakup of the asset distribution, today in T30, we have, as of December data, which has been published by AMFI, 56.5 lakh crores is in the top 30, but 12.83 lakh crores in B30. So the gap is narrowing very fast. And more importantly, in B30, 86% of assets in equity schemes, which is in 2024, went up by 83% from 2023. But in T30, it is 55 as against 54 in November of 24. So there is a massive participation in B30 locations, which is showing a very strong number, particularly in equity-oriented schemes. Which geographies I will not be able to tell you because that is something which I'm yet to have to get to check an update on. But broadly, we are seeing a lot of tier 2, tier 3 participations coming in. Even we feel when we meet at various seminars, we realize that there is a massive opportunity in terms of smaller ticket sizes and larger volumes being
Absolutely.
played out by virtue of number of investors.
Absolutely. Nasser, this is a very important point that we picked out as well. And maybe we should discuss this separately sometime as well. But today, this was the last question. So thank you so much for joining in with us, helping us decode the AMFI data and the trends that you're expecting to see going forward as well. So thank you so much for that. And thank you so much, viewers, for tuning into Mutual Fund Corner on CNBC-TV18. It's a goodbye from myself as well as the team who put this show together. But up next, you have the last star of trade and closing bell. We'll take you through that.